The private sector has stabilised. That's according to the latest reading of S&P Global South African Purchasing Managers Index. For April, the PMI came in at a neutral 50 points. That's after a 4-month downturn, which signals a mild recovery in business conditions. The improvement was supported by a slight pickup in sales and stronger supply chains. But despite the upswing, optimism for the year ahead has dipped. That's as firms remain concerned over domestic and international politics. Electricity Minister Kgosienzo Ramokgopa has unveiled a framework that will allow energy users to choose their power sources. He says this will allow users to not be held captive by Eskom. Speaking at a media briefing on the updated regulatory rules on network charges for third-party transportation of energy, the minister stated that the framework would also facilitate greater investments in the country and improve network reliability. SAA has confirmed that a cyber breach of its systems at the weekend disabled a number of its internal and customer-facing digital structures. The carrier says it responded to the incident by putting measures in place to ensure continued service for its core flight operations. It's also launched an investigation into the matter. This adds to the growing number of cyber attacks on government-linked entities. The SA Bureau of Standards, for instance, has experienced 3 cyber attacks in just 5 years. Solid, that's how Gold Fields has described its start to 2025. The miner has posted a 19% year-on-year rise in first quarter attributable production. That has all its sites up to output, most notably in South Deep. After addressing various challenges there, the mine delivered an annual increase in production of 24% during the period. Given this first quarter performance, Gold Fields says it is on track to meet full-year guidance. Meanwhile, Gold Fields and AngloGold Ashanti have paused their discussions about a proposed joint venture to combine their Tarkwa and Iduapriem gold mines in Ghana. The tie-up was first suggested in 2023, and since then the firms have been in discussion with the West African nation's government to get the necessary approvals. But now the companies have agreed to focus on improving the current standalone performance at their respective sites. Metrofile is in advanced talks with a single party that is looking to take over its business. This comes a month after the firm first announced that it had received a number of approaches. The company says it has allowed the single party to start a high-level limited due diligence, and shareholders are advised to exercise caution when dealing in the company's shares until a further announcement is made. Further afield, Ford Motor suspended its annual guidance because of uncertainty around U.S. President Donald Trump's tariffs, saying the levies would cost the company about $1.5 billion in adjusted earnings before interest and taxes. Here's more detail in this report.
U.S. auto giant Ford says it's going to take a $1.5 billion hit from President Donald Trump's tariffs this year. It's also the latest car maker to drop its annual forecast, blaming uncertainty over Trump's policies. Ford said they're waiting for more clarity over retaliatory tariffs and how consumers may react to higher prices. Executives also said that overall they see import duties adding $2.5 billion in cost this year. They say that's mainly related to importing cars from Mexico and China. However, the company says they've reduced costs by $1 billion already, in part by shipping cars from Mexico to Canada via bond carriers, so they aren't subject to tariffs. CEO Jim Farley told analysts that, quote, "It's still too early to fully understand our competitors' responses to these tariffs." Recently, rival General Motors reported a more severe outlook than Ford. It cut its profit forecast and said tariffs would cost it $5 billion. Meanwhile, Jeep maker Stellantis, like Ford, has also suspended its guidance over uncertainty ahead. Last month, Trump offered some relief on tariffs for auto parts, giving credits of up to 15% of the worth of a vehicle if it was made in the U.S. However, some estimates say auto import tariffs are expected to add $100 billion in costs this year for car makers in the country.